This is Josh Jelinski, the financial quarterback. Don't touch that dial. Hi, everybody. This is Josh Jelinski, the financial quarterback, with one of our favorite guests, Dan Pilla of Pilla Tax, one of the guys, first people ever to take on the IRS and win. Dan, for those who are not familiar with your work, describe your background.
Yeah, sure, Josh. First of all, thanks for having me. It's always a pleasure to talk with you about these tax things. My background is that of a tax litigation specialist, which means that I don't prepare tax returns for a living, but I get into the act after the IRS calls the return into question. I deal with individuals and small businesses that are having tax problems, whether it's audits, appeals, collection. About 70% of the work we do here is collection defense, helping folks with tax debts that they owe and can't pay. I've written 14 books over the course of my career, and I've been on thousands of media interviews like yourself over the years, and that's where I'm at.
Yeah, I remember hearing you on WOR, we've been on WOR for, I don't know, the last 15 years. And I sort of took over as the leading financial guru from the Dolans. And you were on the Dolans, and
I met Ken and Daria Dolan in the late 1980s, Josh, and I think the first time I was on their program at WOR in studio with them, and they had a TV show, I believe it was on CNBC at the time. And so that would have been 89 or so that I got associated with them. And we did dozens of shows over the years before they retired. Yep, no doubt. We did a lot of seminars together too.
4 decades. So I want to talk to you about a lot of stuff. What do you want to talk about first? What's the latest tax tips?
Latest thing that's going on now, Josh, of course, with the new administration coming into power, about a month from now, right? The question is, what are they going to do about the expiring tax provisions? The Tax Cuts and Jobs Act that was President Trump's tax reform act, right back and took effect in January of 2018. All of those provisions expire at the end of 2025. So Congress has to do something to correct those expiring provisions, because if they don't, there's going to be an across the board tax increase for middle class Americans. The mantra during the last election cycle, and really ever since the Tax Cuts and Jobs Act took effect in January of 18, was that it was nothing but tax cuts for the rich, but that is demonstrably false. The fact is that the vast majority of the provisions of the tax cuts of the Jobs Act was specifically pointed at middle class tax relief. So anybody that claims it's tax cuts to the rich and that we should let it expire or repeal it, they just don't know what they're reading, or they're lying, one of the two, because the fact is that these benefits hit middle class Americans squarely. And as I said, there'll be an across the board tax increase if these things aren't extended.
Now, don't you think with Trump winning re-election, they'll all be extended and actually things might be broadened, deepened, maybe even better tax relief?
Well, I would certainly hope so. I mean, as I said, this was his baby from the start. And so I got to believe now, with control of Congress, that this is exactly what they're going to do. It would be a disaster if they don't do it. What I want to see, though, Josh, is that to the extent that these tax cuts are beneficial to the middle class, that they're made permanent. All right. Rather than having a sunset date 5 years or 10 years off into the future or whatever it is. However, that said, the reality is there's no such thing as any permanent tax code. You've been paying attention to this for a long time as well. You watch Congress as much as I do, and there's no question that you understand the fact that whoever is in power, the first thing they do, the very first thing they do, is start stirring the pot on the tax code. So, temporary, permanent, really, what does it mean? It doesn't mean anything. What we need is fundamental tax reform at its core. And, whether that happens, of course, remains to be seen.
Something good could be done. Now, what about BOI? I heard it was off, then it was on.
The BOI is the beneficial ownership interest statement that was put into the law about a year, well, what was it, year and a half, 2 years ago or so, that it was passed, that requires any entity in the United States, such as a corporation or an LLC or an exempt organization, although exempt organizations don't have to follow this specific rule, have to file a report with the Treasury reporting the beneficial ownership interest. In other words, who owns this corporation? All right. Anybody with an interest in the corporation has to be disclosed. It's really a repetitive sort of rule because, you're filing these tax returns anyway for these entities that are reporting the shareholders, all of the K-1s that get reported for LLCs and partnerships and corporations, whether it's an S corp or a C corp, all those 1099, all of those K-1s get reported to the IRS. So they know who the shareholders are anyway, but yet there's an additional layer. Now, it was declared unconstitutional here about a month and a half ago or so. There was a court I believe it was in Texas, that declared it unconstitutional. Now, I have not heard, Josh, that there's been a change to that rule. That I have not seen. Now, no question, it's on appeal. That's undeniable.
I think this is so egregious. Why is this so egregious?
Well, it's the so-called Corporate Transparency Act, which they always give us this nonsense about battling international terrorism and battling money laundering. I would like somebody to explain to me how the disclosure of information that's already in the hands of the IRS, just disclosing it to another department of the Treasury, is going to battle money laundering and international terrorism. So it's nonsense to start with. What's troubling about this particular law is the penalties are egregious. All right. The failure to file this form carried a penalty of $500 a day for every part of a day, for every day that form was not filed. And so this is a situation where the Treasury Department, the federal government, could have used this as a hammer to pound individual citizens, doing business as corporations, because the vast majority of people in America doing business as corporations are small business people, right? They're not IBM and it's not GM. That's the problem here. It's what they're focused on is these mom and pop LLCs and mom and pop corporations. And this was a hammer that they could have used to pound the snot out of the existence of these small businesses under the guise of not filing this report. And what I came down to, what I keep coming back to, Josh, and what I said right from the start, is why do they need a separate report? All right. All of the information they are seeking is found on the business tax returns that these same businesses file with the same Department of Government, the Department of Treasury, right? So if they want information about the ABC Corporation, all they got to do is go to the tax records to get information about the ABC Corporation. As a matter of fact, what's fascinating about this BOI statement is it really is just a very simple information return that does nothing but report who the owners of the corporation are. Well, yes, that information's already filed with the IRS, because you got to file the K-1s with the IRS that show who the shareholders are and what their ownership interest is, 10%, 20%, whatever it happens to be. So all of that gets reported to the IRS anyway. There's no financial data on the BOI statement. All the financial data is in the tax return. So how can a form that presents no financial information whatsoever aid in money law in anti-money laundering and anti-terrorism? It just doesn't make any sense.
Yeah, I think this is a big government takeover of small business LLCs. Also, privacy. A lot of people do these things for privacy, estate planning, asset protection. I don't think anyone's doing this to evade the law.
There was really three things that he pounded on during the election: no tax on Social Security, no tax on tips, and no tax on overtime. And I believe the tax on tips and the no tax on tips and the no tax on overtime are not sound tax policies. I believe that these two things would introduce more distortions in the marketplace than they would cure in terms of middle class tax problems. The way you cure middle class tax problems, Josh, is you reduce the tax burden on the middle class in an across the board fashion, rather than saying, well, we're going to decide not to tax tips. But what about all the wage earners out there, Josh, that aren't working for tips? They don't get a tax break under that proposal. And the same with overtime. Not everybody works for overtime. There's millions of workers in the United States that are salaried workers that get the same amount of money, whether they work 40 hours a week or 60 hours a week. All right. So those people would see no benefit from that as well. And yet those people fall right into the classic definition of middle class taxpayers. If we're going to have middle class tax relief, which certainly I'm in favor of, we need to lower the tax rates across the board for middle class wage earners. And that's the simple way to do it. That's the best way to do it that will introduce the least amount of distortions in the marketplace. For example, if we say, if Congress does pass a law that says we're not going to tax overtime anymore, well, how are employers going to redefine their work week? Are we going to see employers saying, well, we only got a 10-hour work week in this company, and you work your 10 hours and you get your regular pay, but then anything over 10 hours is overtime and you don't have to pay taxes on that? I mean, how is that the kind of thing that we're going to see going on across America? It that to me, it's just too confusing, and it's too parochial in terms of the benefits that it provides to individuals. We got to reduce the rates across the board. That's the key.
No, I agree. And we've had Stephen Moore on, who's part of his Council of Economic Advisors. And I kind of pushed him on that because Moore is more of a libertarian guy. And he's really trying, from what I hear, and I can only be hopeful, right? If, maybe it won't happen, maybe it'll be like the first term, where they are looking to flatten the tax code, make it, lower the rates, things like that. I hope so.
I know Stephen Moore well. I've worked with Steve very closely for a number of years when he was the director of fiscal policy studies at the Cato Institute. So Steve and I worked hand in hand together on a number of things, and recently too. And so I agree with Steve's analysis that the goal is to reduce these tax rates, no question about it. But I think we got to go to a next step. There's a lot of people that are arguing for a flat tax and contending that we solve all of our problems if we adopt a national retail sale, if we adopt a flat income tax. But that is not going to solve America's problems with tax law enforcement and administration. In my opinion, we got to eliminate the income tax and the Internal Revenue Service altogether, completely, and adopt a national retail sales tax, which I believe, if properly structured, the way I've laid out the plan for over 30 years now, is to adopt a broad-based consumption tax on all consumption goods and services at the retail level, at the point of purchase. That would abolish the income tax and the Internal Revenue Service completely.
A guy can dream, can he? I don't
Yeah,
know.
yeah, no doubt.
Um, hey, who would have thought they had this Doge? Hopefully they're successful.
Well, yeah, and we'll see what happens with that. I've got a lot of high hopes for that as well. On the other hand, Josh, you probably remember the Grace Commission. All right. J. Peter Grace was the chairman of the Grace Commission that was appointed by President Reagan back in the early 1980s. And the challenge or the charge for the Grace Commission was to do exactly what the Doge is intended to do, and that is to comb through these federal government agencies and look for waste, fraud, and duplication in all these various dozens of government agencies that we have, and cut out the waste, fraud, and duplication in such a way that will save taxpayers money, but not cut the meat of the programs that the federal government is offering, right? So, theoretically, we'd get the best of both worlds. The programs would continue to operate, but with no fat, right? We cut out the fat. Well, the Grace Commission issued a report to Congress, and I forget the year, but it was plus or minus 1984. You can go to the internet probably and find it. And they made over 1,000 specific recommendations to Congress to cut waste, fraud, and duplication in these various agencies. And do you know how many Congress adopted? Not a single one, not one of them. So is the same thing going to happen with the Doge? I don't know. Will remain to be seen. But as you said, a guy can dream, right?
Somebody was telling me X was the most downloaded app. X is the app formerly known as Twitter. Um, it's confusing, it was Twitter, now it's X. But I'm hopeful with Elon kind of at the helm. Maybe I'm too hopeful. Maybe I'm too naive. But
A guy who can put together a team that can figure out how to parallel park a rocket ought to be able to find waste, fraud, and duplication in the federal government and figure out a way to get rid of it. Frankly, I don't think it's that hard of a task to find waste, fraud, and duplication in the federal government. I mean, we've got a federal budget. You know this as well as I do. What are we, $6.5 trillion of spending now? Don't tell me there's not waste, fraud, and duplication in that spending package.
so let's change course, talk about the 90,000 IRS auditors. that were hired by the Biden administration. How many did they actually hire? Did they hire 90,000?
It was 80,000 additional workers that was supposed to be spread over 10 years. All right. So there never was a plan, Josh, to hire 80 or 90,000 workers in 1 year. That never was the plan.
Do you know how many they ended up hiring?
Oh yeah. They've ended up hiring about 10,000 workers over the last 2 years. Now the problem with that, and this is what I pointed out in my articles in National Review when I discussed this plan. I discussed it rather at length in those various articles. The problem is the attrition that's going on in the IRS and the retirements that's going on in the IRS. The about 30%, starting in 2022, roughly about the time that they were seriously talking about funding the IRS to be able to hire these 80,000 people. The 30%, roughly 30% of the IRS's workforce was eligible for retirement in 2023, 2024, and 2025. All right. So the IRS at that time had roughly 85,000 employees. So, okay, they hire 10,000 workers, but during that period of time, another 10 or 12 or $15,000, 15,000 workers are retiring. So the idea that this plan ever would have doubled the size of the IRS is just not accurate, Josh, because too many of these people are retiring. And never mind the retirement. Set the retirements aside for just a second. The IRS always has about a 5% attrition rate in its workforce. All right. So roughly 80,000 people in the workforce. There's 3, 4, 5, 6,000 people that quit the government or quit that agency at least every single year and move somewhere else, whether it's into the private sector or some other government agency. So they're always dealing with retirements and attrition. So the idea that they're going to end up with a workforce that's twice the size that it was just isn't. It's just not going to happen.
Now, I'm hearing from a lot of my friends, CPAs, accountants, that the audits in the last year or two really exponentially increased.
Oh yeah, no question. Yeah, absolutely. And this is a function of funding, not so much as of personnel. Because the IRS has really developed the audit process into an art form where they can hone in on specific issues that are on a tax return. And so, all during the course of the COVID years, which started, of course, in 2020, 2021, 2022, most of 2023, the IRS was largely shut down. But beginning in January of 2024, Josh, they launched a couple of programs. First of all, they turned loose the audits, no doubt about that. Secondly, they launched what they call their non-filer initiative. All right, the Treasury Inspector General for Tax Administration released a report in late 2023 pointing out that the IRS has identified as many as 11 million tax return non-filers, and that number has increased over that previous 5-year period of time, right?
So 11 million people that should be filing are not.
That they know of. All right. Remember, identified non-filers. So what that means is the IRS has got income records in their system showing that this citizen over here made, let's say, 50 or 60 or $70,000 and hasn't filed a tax return. The only way the IRS knows that is because they got an information return, such as a W-2 or 1099, from a third party showing that that person has earned income. All right, so they know that they've identified 11 million known non-filers, but there's millions more unknown non-filers, right? People that are working for cash, they're off the books, they're in the underground economy, they're earning income, they're supporting themselves or their family, but they're not filing tax returns, and the IRS doesn't know about it because there's no third-party reporting. Who knows how many of those folks there are?
Some of my CPA friends, they said basically three candidates. I forget the third, but they said basically anybody who bought a plane, anybody who gave large gifts to charity, and then there was some other category. They said, though, these people were always were kind of audited in this 2024 sweep.
And you can really go beyond that. Those things have been historical issues that the IRS has looked at. Somebody that's got a company. I had a client years ago. I mean, this was way, way, way before Biden, way before COVID, way before any of this stuff. I had a client who operated whose business owned a private airplane that they operated for business purposes that the IRS audited, and we were able to establish the business purpose for the airplane. Okay, fine. That's something that the IRS always has targeted. No question about that. Now, they've increased they've increased the scrutiny of these private airplanes because the question is how many personal benefits are being bestowed on corporate employees as a result of their being able to use the company plane for private purposes. That's really what the focus is. But again, that's something that the IRS has looked at historically. But I'll tell you this, more at risk in this wave of audits that's coming in is small business Schedule Cs that show a loss of income, right? You show a loss instead of a profit. That's something that the IRS looks at. The number one, well, probably not the number one, but one of the single most audited issues for small business tax returns is their mileage expense that they put on their tax return, because unfortunately most small businesses just don't keep proper mileage records. The other thing they look at is home office. All right. This is something that is scrutinized very routinely. So, there's not many people that have to worry about a private airplane audit, but there's a heck of a lot of small businesses out there that have to worry about or should be concerned with, at least aware of, not go to bed worrying about, but at least be aware of that the fact that the IRS looks at these travel expenses very, very significantly. And if you don't have the right mileage log to support your mileage deduction, you're going to have an audit problem.
So yeah, we've talked about this. My producer and I, his accountant said, don't even take the home office deduction. I've heard you want to take it because that's how you get the justification of your mileage better. Where do you stand on that?
Well, my answer is very simple. First of all, the advice that you talked about, that your producer got, is very common advice from CPAs that don't understand the audit process. Right? They say, "Well, don't claim the deduction. Why put a target on your chest? Nobody wants to be a target of the IRS." Right? And there's some logic to that. Except here's what the problem is: if you don't claim the deduction, that simply means you're paying more taxes than you owe. You're increasing your own tax liability voluntarily, and you have no legal obligation to do that. My response is claim every deduction you're legally entitled to claim, reduce your tax liability to its lowest legal limit, but don't but do it without risk. And what I mean by that is make sure that you've got the documentation to support the deduction you're claiming. If you're entitled to claim a home office because you're a self-employed person, I say by all means claim it. Just make sure you understand the rules. In my book, Dan Pilla's Small Business Tax Guide, I have an entire chapter in that book, Josh, that specifically shows you how to claim a home office deduction. I show you what the rules are to establish the home office, what you have to meet in terms of factual considerations to be allowed a home office. Then I show you how to claim it. Then I show you how to document it, so you don't have to worry about it. You don't have to worry about an audit if you can back up what you put on your tax return.
No, exactly. And that book is Dan Pilla's Small Business Tax Guide. So if you or any of our listeners want that book, I will give you a copy free if you schedule and keep a no obligation review with us at 888-988-JOSH, or go to your website, Dan, for that book.
Yeah, the website, Josh. Yep.
Do you prefer that they buy it on Amazon or your website?
No, no. If you buy the book off my website, which is taxhelponline.com, that's all one word, no spaces of any kind. Taxhelponline.com. You buy any book off my website, whether it's the Small Business Tax Guide or any of the rest of the books we have there, you get a free 15-minute consultation directly and personally with me. So buy your book, the Small Business Tax Guide, read through it, write your questions down, get on my appointment calendar, and I'll answer all your questions for you.
Now, so you like the home office deduction, the mileage deduction. We've talked about this with you before. You're big on documentation, but a lot of people are sloppy. What are some tips for documenting things?
Well, just get it through your thick head that you have the burden of proof. That the most important thing to understand is that when we're talking about a civil tax audit, even a civil tax collection situation where the IRS is trying to get money out of you, they don't have a burden of proof, Josh. The IRS doesn't have to prove that you did it wrong. You have to prove you did it right. And so it's fundamentally necessary to understand that if the IRS challenges something on your tax return, you as the taxpayer can't sit back and say, prove it. No, what the taxpayer, have to prove it. And so you got to make sure that when it comes to mileage, for example, You got to have a mileage log. The mileage log has got to be contemporaneous. It's got to document where you went, the mileage traveled, the day it was traveled, and what the business purpose was. Now, you don't have to write a novel for this stuff, and there's all kinds of computer apps out there and phone apps that you can use that track this stuff very systematically for you. So it's not a matter of sitting there writing this stuff down every minute. But the fact is, if you have a mileage log and you can state with a straight face that these miles were incurred for business purposes, you're not going to lose your deduction. On the other hand, if you don't have a mileage log, I don't care how much you've written off in miles, whether it's $100 or 10,000, you're going to lose your deduction if you can't support it with a mileage log.
Do you help individual clients?
Yeah, absolutely. Yeah, yeah. That's primarily what I do, Josh. Is representation and coaching for people that have IRS issues.
And are you winning most of your I mean, I know you have a good track record, but
We got a saying around my office. They never get tired of getting their ass kicked, and I'm just the guy to do it.
that's great.
We have, particularly when it comes to collection defense, well, audits too. Here's the thing about audits. People are terrified of audits, and if you look at IRS statistics, you'll see that of the tax returns that are audited, almost 90% of those tax returns end up owing more money, right? So I think the number is like 87, 88%. So you go through an audit and you can just bet money that you're going to owe more money. The good news is the decision of a tax auditor is never final. You have the right to appeal the decision. And this is where most people fall down. They don't appeal the decision, they don't challenge the tax auditor. And I will tell you that IRS statistics, particularly the stuff coming out of the US tax court, tells me that the IRS's auditors are wrong between 60 to 90% of the time in the answers they come up with in the decisions they come up with in the audit process. So when you appeal your case to the Office of Appeals, you're going to win your case most of the time. Now, here's what happens, Josh. Typically, you go through a tax audit, and the IRS, the auditor will say, "Well, I disallow this," and there might be 5 or 6 different adjustments to the tax return. And he comes back and says, "Okay, you owe us $50,000, right? We've disallowed this, and this. Now you owe us 50 grand." You execute that appeal and you might win 3 or 4 of those 5 issues. And maybe there's a problem with your tax return, and maybe the IRS is partially correct, right? If they're wrong 60 to 90% of the time, it means they're right some of the time. And so now your proposed or your assumed tax liability goes from 50 grand down to maybe 10 or 12 or $8,000. And nobody wants to pay that kind of money if they don't have to, but that's a far cry from 50 grand.
What about real estate help, real estate tips? A lot of people recommending people do the short-term rentals or Airbnbs. Do you have any help for Airbnb people?
Yeah, you can do that stuff. I mean, there's no problem doing any of that stuff, Josh. The key to all of this is record keeping. It's too many of these people fly by the seat of their pants when they're doing this. Their accountant might say, "Oh, rent out your house for 14 days or 13 days out of the year, and you don't have to pay. You don't have to report the income on these short-term rentals." And that's true. That's fine. But you got to keep the documentation. You got to prove it. You got to be able to show exactly what's going on and demonstrate what the facts and circumstances are of your case. Any of this stuff is good. There's no doubt about that. The key to it is documenting your position.
You mentioned there's different ways to document. I believe it's in the small business book. There's 5 methods like contemporaneous logs or something, receipts, Amex bills, and there's confusion around this where I've even heard people lose audits because they didn't have a receipt. And you say, well, that's not true. They could actually reconstruct it ethically.
First of all, the IRS will say, "Well, you have to have a receipt to claim this deduction." Okay, you give them a receipt and they say, "Well, now you need a receipt and a canceled check, both, to claim this deduction." That's how they trap people, right? That's what they do to bluff people out of the deductions and to get them to agree that, yeah, I must have made a mistake on my tax return and now I owe you all this money. There's 6 different ways to prove deductions, and these 6 different strategies can be used separately or together as combinations, right? The first thing is a cash receipt. You go to the store, you buy an item that's used in your business, you get a receipt. All right, that receipt is evidence of the expenditure. And as long as you can provide the information that shows the business purpose, it's a business deduction. So cash receipt is one of them. A canceled check's another one. The problem with a canceled check is it doesn't always have the information on the check that shows the business purpose. So if you combine the canceled check with a receipt, now you've got a tighter package of documentation. But the check by itself can certainly be proof of the expenditure. If you're writing a check to some third party organization to pay for advertising, for example, well, you can go online and get information about this company to demonstrate that it's an internet marketing company, for example. And the fact that you paid this company $X thousand shows that shows that you're paying for internet marketing. All right, let's go to the third thing would be an invoice from the company or a third party statement. So now, if I've spent money with this internet marketing firm, I would get a statement from them combined with my canceled check, and now I've got a rock solid package of information. Logs, contemporaneous logs. A log would be like the mileage log that we're talking about. There's some deductions that you aren't going to be able to sustain without a log, and mileage is one of them. That's a contemporaneous record that you make at the time of the event to record what it is that you're doing. All right. So the next thing is reconstructions. Let's say you lose records. People lose records all the time.
The receipts, like they used to, hold up under scrutiny and just under time. I don't know if you noticed, receipts now fade after like 30, 40
Oh,
days.
Oh yeah, no doubt. They fade fast, absolutely. So you can scan your receipts and capture those there's all kinds of apps that allow you to do that. Just put them on your scanner, scan them into your computer, and now of course you got to maintain the drive that's got them on there, right? That's another thing. But people lose records all the time, Josh, and this is one of the things that I'm dealing with pretty regularly with small businesses that have lost their records. They're paying utility bills, they're paying for materials and supplies. Well, where are my records? Let's go back and reconstruct the records. Well, how do we do that? You look at credit card statements, you look at bank statements, you go get third party records, you get these people to give you the documents they have. All of these things are useful for reconstructing records. And then the sixth technique, the last technique, is to use an affidavit or sworn testimony. All right. And I do this all the time. And in fact, we back up reconstructions with the testimony of the taxpayer. Remember, the burden of proof is on the taxpayer to establish that they spent money. All right. Testimony is one way to do that. All right, your testimony under oath, in this case, it's in writing and it's notarized, and you have a very detailed letter of explanation that you have notarized that you provide to the auditor that explains what the nature of your business is and why you're spending money on this item or that item, and the best reconstruction possible as to the amounts of those items. I talk about this in my book at length, how to do this, and I'm telling you, it works, Josh. When it's done properly, it works. So you got those 6 specific strategies that are used for proving deductions. Any one of them standing alone can work, but the more that you put together, a receipt with a canceled check with a year-end statement, that sort of thing. The more of that you can put together, the more solid a package you have.
Do you like the idea of just funneling all of your expenses through credit cards?
Here's what's more important than doing that. What's more important than doing that is to make sure you're not commingling business and personal expenses into one bank account or one credit card. All right. You could do it through a bank account. That's fine. You can use a debit card instead of a credit card. That's okay. But don't commingle. You don't want to be paying your business marketing expense out of the same bank account that you're paying for your kids' hockey lessons with. All right. Because the IRS looks at that stuff and they will immediately assume that because you're paying personal expenses out of this account, it must be a personal account. And so therefore every expense is personal and therefore you can't write them off. When you are segregating expenses, personal account over here, all personal expenses paid this way, business account over here, all business expenses paid that way. When you're doing it in that fashion, you can declare to the agent, you can use an affidavit to support this. 100% of the expenses coming out of that account are business expenses for this reason, or this reason. And that puts you on rock solid footing.
Any other tips on the whole audit defense before we go to a next topic?
Well, the bottom line is just as I said before, just understand that the burden of proof is on you. Just make sure you know that you're going to, if you're called on to do so, you will have to prove that the tax return is correct.
What about people? You mentioned this commingling of business and personal. I find that with most people, they get that. They have a separate personal, they have a separate business, but sometimes they will funnel personal through their business. I heard from one of my CPA friends, as long as you back that out, let's say on your QuickBooks, that this was personal and you declare that you're okay.
Yeah, if you got the proper record keeping to do that, if you've got a bookkeeper that's paying attention to the details, you're exactly right. Now, my experience is different from your accountant's experience. My experience is that most small businesses do not segregate their personal and business expenses. They got them commingled. And your accountant's exactly right that yeah, you could sort through that and figure it out, but it becomes a chore to do it. Now we got to go through the bank statements a line at a time. What was this? Well, that was my kids' hockey lessons. That goes over here, not deductible. What was this expense? Well, that was my internet marketing company. Okay, that goes over there. That is deductible. It's not difficult, but it's tedious if you're not doing it the right way on the front end.
So let's talk about some new tax proposals and also some tax tips for 2025 as we kind of go into the new year. If somebody's listening right now, what are 5 things they can do to lower their taxes immediately?
Well, you're going to have to take those steps before the end of the year, not going into the new year. I mean, I don't know about 5 things necessarily, but first of all, you can make charitable contributions up to the end of the year. If you've got you've got some money you want to spend on charity, now's the time to do that. You'll get that deduction. If you're under the SALT cap, the state and local income tax cap, which is $10,000, pay your state taxes by the end of the year. You get a deduction for state taxes when you pay them. So a lot of people don't pay their state taxes until they file their tax return in April. Well, now you've delayed the deduction for a whole nother year. The other thing is making a contribution to a retirement plan. You've got certainly till the end of the year to do that, but I think most retirement plans, Josh, you probably know this better than I do, can be funded up through April 15th, the time of the due date of the tax return. But the sooner you do it, the sooner you get the benefit of the growth, right? So keep those things in mind. The advice that I give to small businesses all the time, particularly small businesses, is very important to start looking at your total 2024 profit and loss picture right now. All right. What was my income? What were my expenses in 2024? What's my bottom line? Because small businesses have the responsibility to make estimated tax payments over the course of the year. The last fourth quarter estimated payment is due January 15th, and you have a responsibility to pay 90% of the current year's taxes, that'd be 2024, or 100% of last year's taxes, that'd be 2023, whichever is less through the estimated tax system. All right. So small businesses, two problems with small businesses that I see routinely. Number one, they haven't made their estimated payments, and so the first time they know about what their tax liability is going to be is when they get their tax return back from their accountant, and the accountant says, "Oh, by the way, you owe the IRS $13,000, 13 grand. I had no idea." Now they're blindsided, right? So that happens. Then what happens is they get themselves on the tax debt treadmill. And what I mean by that is they're using current tax revenue. So now it's 2025. They're supposed to be making estimated payments in 2025 for 2025 because their 2024 liability should have been paid, but it wasn't. So they're taking their 2025 tax revenue and they're using that to pay 2024. Now they're getting themselves behind for another year and then another year and then another year. So this is a significant problem that can be avoided if you're babysitting your profit and loss situation throughout the course of the year. So don't wait until April 15th when your accountant tells you you owe 13 grand. Look at your P&L situation right now and get your arms around it right now so you can start getting that under control before you've got a delinquency problem.
What about, so you mentioned retirement plans. And yeah, you have till the tax paying filing deadline. It used to be you had to do it by the end of the year. So December was always a very difficult month for us, but now they've kind of eased that to make 401k adoption and solo 401ks, all those things. People should look at solo 401ks, defined
Yeah, I
benefit
was just
plans.
going to ask you, Josh, what is the deal with the solo 401k that I've been reading about? I'm not a retirement plan expert, but I've been hearing a lot about this. What is the story with that?
Well, Most accountants recommend small business owners do a SEP. And the rule is, 25% of your compensation can go into a SEP. The beauty of the solo 401ks, you don't have those rules, and you could actually pair a Roth 401k with the solo 401k and with the employer and the employee contribution. You can get up to like a $75,000 deduction with no administrative expense if it's under 250 grand. Now you could pay, if somebody's hiring us and they're paying our fiduciary fee, um, you know, so basically you could set up an account with Fidelity, Schwab, whatever through us by your taxpayer filing deadline, get a $75,000 write-off with very little administrative expense. And, there's no 5,500 filing due until you're over 250,000. So solo 401k is really powerful.
Yeah, that sounds fantastic. And as far as the write-off is concerned, write-offs are marginal, right? The deduction is always marginal. So, for example, if you're in let's just make the math simple and say you're paying taxes at the rate of 25%. All right, if you spend $10,000 on a business expense, you get a tax deduction for that. That saves you $2,500 in taxes. It's marginal. The $7,500 is out the door on whatever expense you incurred. But if you fund the solo 401k with the $10,000, you get your $2,500 deduction, but you still have the 7,500 bucks. It's in your retirement account. It's your money. And so, yeah, you got to fund the account, but it absolutely reduces your tax liability while leaving you with the asset in your hand still.
Yeah, and I think the reason it's becoming bigger is just social media. So people are now, doing little Instagram reels or TikTok videos on it. I think it's been around for a long time. But for some reason, CPAs, accountants, just when you have to file your tax return, they just would go to the SEP. That's what they knew. SEP's simpler, it's easier. And the solo 401k is very similar to that. You don't need all of this administrative expense, but so it's a great benefit. And you can do a Roth. If you like the Roth powerful tax-free growth, you can pair a Roth 401k with the solo. And I'm looking up the annual limits. It's 76,500 for 2024. If you are 50 and over, your contributions cannot exceed 76,500. For those under 50, total contributions cannot exceed 69,000. So that's huge.
Here's one of the problems with the income tax laws that we have right now. There's no better example than the retirement world, right? The retirement fund world. We got a tax code that consists of more than 4 million words. And I'll bet 1 million of those words are devoted to retirement plan funding, right? There's about 7 or 8 different kinds of retirement funds. You get IRA, 401k, the simple IRA, the 403b, all right? All of these different plans are 7 or 8. You could probably name 9 or 10 of them. I don't know how many there are. There's too many of them, right? There's too many of them. Why can't we have one simple retirement plan program? All right. Or maybe one for an employee, one for a self-employed individual. Do we really need to have all these different plans in the law that create all these confusions that have their own separate sets of arbitrary rules that people have to keep in mind if they want to use this plan or that plan? To me, it's a perfect example of how out of control our tax law is.
Oh, exactly. And then there's the savers credit. So if you make under a certain amount, you do the IRA, you get money. If you make over a certain amount, you don't get the money. Yeah, I mean, we should just I don't know, you should just have an IRA and a Roth IRA, and they should allow you to put in probably up to this solo limit, the IRA. So if you have a lot of money, you want to bank it for your retirement, you can, whether you're a small business. And what ends up happening is the people that make the most are able to take advantage of these things the most.
The lower income folks, not that they couldn't take advantage of these things if they want to, they certainly can, but they don't know about them because they can't afford to hire the hot shots that know what the answers are. And that's just fundamentally wrong.
And we have a guy, Brian, what's his name? Brian Kane. He works with us. He works for a company called Preferred Pension. He's the hot shot that says, okay, if you make X, you can get $100,000 deduction if you do a cash balance plan. But oh no, instead of doing that, you should do this. You should do a solo 401k. You should do a profit sharing. You need a whole, actuarial team in many cases to figure out which programs are right for you. It's very ridiculous. And I mean, like you said, if we just got rid of the IRS, we'd probably save a lot in administrative fees.
Right off the bat, the IRS's operating budget is about, well, their what they call their normal budget is about $12.5 billion a year, but then they get the supplemental funding that came from the Inflation Reduction Act, which was, that's a farce of a name to begin with. But that was the Biden administration's additional $80 billion of funding. That's $8 billion a year for 10 years, right? So we're talking about $22, $23 billion a year funding the Internal Revenue Service to enforce and administer this law. It's insane spending that kind of money to enforce a tax law.
The other thing, and this one of my CPA friends out of Nevada, he goes, a majority of his tax audits. I mean, he helps high net worth people. They're being audited at a record number, he said. A majority of his audits are people who legitimately gave money to charity. And they're going to tax court. So they're expending taxpayer resources to fight these people. And he's like, I'm going to win probably 90% of these audits because they were all legitimate. And they're just dinking around with taxpayers trying to look for something under some rock.
What they're betting on, Josh, in the vast majority of cases is the fact that people wear out in terms of patience and ability to fight back, and they just give up and pay. Now, unfortunately for most folks, the pay part is not an option, right? They don't have the capacity to pay. I mean, my small business clients, they go through a tax audit and the IRS says they owe 50 or 60 or $70,000 and they lose that audit. These people don't have the capacity to just write a check and pay them off. They're not 7-figure income people. All right. These are low 6-figure income people. They're not rich by any stretch of the imagination. And so the IRS takes advantage of that. And so now you got these people that move from audit to collection. And this is the nefarious part of the whole process. All right. It's one thing for some clown at the IRS to say, yeah, you owe us 50 grand. Okay, that's crazy. You're out of your mind. And then you go on with your life. Well, the next thing you know, you get a notice from the IRS, a collection notice that says, hey, about that 50 grand we say you owe. Well, now it's not a game anymore. Now they want the money. Now they're threatening to enforce collection. And enforced collection means wage levies, bank levies, property seizures, and tax liens. So now these people end up in a collection problem, and maybe they're forced into an installment agreement they can't afford, or the IRS files tax liens, and maybe they're undergoing wage levies, for example, or in the case of small businesses, bank account levies. These people are paying taxes they don't owe, and that then creates the real problem.
I got a call from a client this week. They said they got a levy for $237. And I guess they do that because people just pay them and then they just move on.
Well, in a situation like that, where it's considered a low dollar collection case, and generally quote unquote low dollars under $100,000, the IRS will use what it's called its automated collection system, ACS, automated collection, where 100% of the action is controlled by the IRS's computers. All right. So if that person
But
has
what if
just
the
been
computer made a mistake?
well, the computers make mistakes all the time. And if that's the situation, then you've got to be aware of your right to use what's called a collection due process appeal. All right. Before the IRS can levy a nickel's worth of your assets, before they can take so much as a postage stamp, Josh, they've got to send what's called a final notice, notice of intent to levy, and notice for your right to a hearing. That final notice letter says, Dear Mr. Taxpayer, you owe us X dollars. You got 30 days to pay up. If you don't pay in 30 days, we can enforce collection unless you file a request for a collection due process appeal. This is probably the most important right that taxpayers have when dealing with the IRS, this collection, what we call CDP appeal, collection due process. Because when you make that request for an appeal, that stops all collection action in its tracks. It takes the case out of the hands of the collection function, puts it into the hands of the appeals office, and the written job description of the appeals office, Josh, in these collection appeal cases, is to negotiate a settlement with the taxpayer. Right. So if the IRS is wrong and you can prove they're wrong, you can get that fixed at the appeals process. If you owe instead of $227, you owe $227,000 and you can't possibly pay it, then the IRS's appeals office has the written responsibility to consider collection alternatives. That might be an offer in compromise, it might be penalty relief, it might be an installment agreement, it might be to close the case as uncollectible because of hardship, that might be an innocent spouse relief. There's all kinds of different potential collection alternatives that can be proposed, and the IRS has to evaluate all of them. And then to top it all off, if you don't get a fair shake from the appeals office, if you think that they failed in their responsibilities to do this or that, consider your collection alternative, whatever the case may be, you've got a judicial tax court appeal right. So you can actually take the collection case to tax court and force the IRS to apply the rules properly to get you into a position where they will not run you over, grind you into powder in the collection process.
Now, what one of my CPA friends said was just, I don't know if this is true, because I called him up on this. When a client asked me this, he said, "Oh, just pay it, and then you could request the hearing and then get the money back." Is that correct?
Well, it depends on the posture. If you just simply pay the tax, then you're probably not going to get a hearing unless you're challenging the accuracy of the underlying assessment. What you can do, though, Josh, is you can pay the tax and make a claim for refund and say, hey, you're wrong. Here's why I want my money back. So you do have a right to challenge the payment, request a refund. You generally have 2 years from the date the tax is paid in which to do that.
It's just crazy. I'm sure they do it because most people pay it, right?
Most people pay. Sure, they do. Absolutely. That's exactly why they do it.
So would you pay it or would you do the appeal first?
I do the appeal. I think that appeal is fabulous.
And that's because you get a real person, not a
Oh
computer.
yeah, you get a real person, absolutely. Yeah, and not only do you get a real person, Josh, you get a real person who's trained to do the things that I just talked about, evaluating collection alternatives, reviewing the correctness of the underlying assessment, evaluating the arguments that the taxpayer makes, looking into the IRS's systems to make sure that they jumped all through all the hoops properly. So you're dealing with an appeals officer specifically trained to handle these due process appeals. I think, my opinion, this is the most important right the taxpayers have. It is critical to use this right if you're in a collection situation.
Like, when do you know your CPA isn't really cut out for this job?
Well, you know your CPA is not cut out for it when he doesn't understand what the final notice letter is. Now the question is the CPA going to be honest with you? All right, and here's a telltale sign. If you get a final notice of intent to levy, and just so we can understand what this is now, it's IRS letter CP90, or LT11, right? CP90, LT11, or if it's coming from a revenue officer, it's a letter 1058. Those three notices are final notice letters. All right. If the CPA tells you that you can call the IRS and get a payment extension, get an extension of time in connection with the final notice letter, then that tells me that he doesn't have experience in final notice letters. And the reason is because the time limit for responding to that final notice letter is 30 days, is fixed by statute, right? The Internal Revenue Code controls it. It can't be changed. Nobody in the IRS can give you an extension of time to file that request for a hearing. All right. So the CPA better be telling you that you've got 30 days to request the hearing. We need to file the hearing request form. They need to know what the form is. It's form 12153. IRS Form 12153, request for collection due process hearing. And if they're not telling you those couple simple things, then that person doesn't have the experience needed to execute the appeal. All right. So you need to find somebody who does, or you need to look at my book, How to Get Tax Amnesty, which has got a chapter in it that shows you how to do the collection due process appeal step by step.
And which book is that?
It's called How to Get Tax Amnesty.
How to Get Tax Amnesty. So you have so many good books. Small Business Tax Guide, How to Win Your Tax Audit, How to Get Tax Amnesty. Go to taxhelponline.com. And if you need help, I'm sure just go to taxhelponline.com and your people can help.
Yeah, absolutely. Yep. All the information is right there.
So you're actually doing the IRS fighting still? You're still doing it?
Yeah, that's the fun part of the job, Josh. I love writing. I love doing the interviews, but there's just nothing better than representing the clients and dealing with winning the cases.
Now, you've said it's not really like they're evil people trying to get you.
Particularly the appeals officers. All right. This is why, and I've said this to IRS people, I've said it to them face to face. I thank God for IRS appeals. All right. Because the people that are in the lower levels of the IRS, whether it's the tax auditors or the tax collectors or the offer and compromise evaluators or the penalty abatement evaluators, I shouldn't say low level, but entry level functions of the IRS, these people have mindsets. They don't necessarily know what the law is. They don't necessarily understand how to apply the law to the facts of a particular case. They don't spend the time they need to spend to go through the file to see what the facts really are. When you get to appeals, you're dealing with people that are trained to evaluate the cases properly. And as I said, their job description is to fix the problem and to negotiate a reasonable settlement. That's where I want to be all day long.
And kind of a final question. Biden's tax law had a lot of benefits for Green New Deal, solar, wind. Maybe I missed out. We got a few days left in the year. I own a building. One of these guys, I don't know if it was you or somebody else, said, hey, get solar panels on my building. Should I do it now by the end of the year, or don't I have to put it in service? There's all these
Yeah, it's all about being in service, no doubt about that. And I'm not an expert on all these credits, Josh. There's a whole bunch of them in the tax code, no doubt about that. But the fact of the matter is, they're not going away, come January 1st. These things are still available until Congress changes the law. And are they going to change the law retroactively with respect to these EV credits? Probably not. These green credits, probably not. These things are changed prospectively, not retroactively. And so, when the calendar rolls over and you're in January and you want to do some of these improvements, I'm sure you'll still get the benefit of it.
any other tax tips that you wanted to share but didn't have time to share?
There's no such thing as a hopeless tax case, Josh. I don't care what kind of a problem you have. There's always a way to fix it. There's always a way to fix the problem.
Thank you so much. Daniel Pilla, taxhelponline.com. And if you call us at 888-988-JOSH for the free review, I'll buy you his book, Dan Pilla's Small Business Tax Guide. Or you can go to his website and get a free 15-minute consult when you buy his book on taxhelponline.com. Thank you so much, Dan.